Your IRS refund just hit your bank account. $3,000, maybe $5,000, or even more sitting there, waiting for your next move. But here's what 92% of Americans do wrong at this exact moment. They treat it like free money. Instead of the financial reset button, it actually is dot. Comment below what you're planning to do with your refund and subscribe for more. Money saving strategies. The moment that direct deposit notification pops up on your phone, your brain starts making lists. New furniture, vacation plans, maybe that gadget you've been wanting. But financial experts who've analyzed thousands of tax refund patterns have discovered something shocking. The next 72 hours after receiving your refund will determine whether you're financially better off next year or stuck in the same cycle. The biggest mistake isn't just spending the money frivolously. It's failing to recognize that your tax refund represents something much more valuable than a windfall. This money is essentially an interest-free loan you gave to the government for an entire year. And now you have a rare opportunity to redirect your financial trajectory with a lump sum that most people never see. Most Americans receive their largest single payment of the year through their tax refund. The average refund in 2025 is approximately $3,200, representing money that could have been working for them throughout the previous year. Instead of viewing this as bonus money, smart financial planners treat refunds as a strategic tool for implementing changes that compound over time. The critical first step that nobody talks about involves conducting what financial advisors call a refund audit within 24 hours of receiving the money. This means immediately transferring the entire amount into a separate savings account, completely away from your checking account. This psychological barrier prevents impulsive spending and gives you time to make strategic decisions about allocation. During this cooling off period, you need to assess your current financial foundation using the hierarchy that wealth-building experts swear by. The order matters more than most people realize because each step builds upon the previous one to create maximum financial leverage. Skipping steps or doing them out of order can actually cost you more money than not receiving a refund at all. Step 1 in the hierarchy addresses immediate financial vulnerabilities. If you don't have at least $1,000 in an emergency fund, your refund's first priority is filling this gap. Without this buffer, any unexpected expense forces you into debt, which typically carries interest rates between 18% and 29% annually. Building this foundation first prevents you from sliding backward financially. Step 2 focuses on eliminating high-interest debt, specifically credit card balances carrying interest rates above 15%. The mathematics here are undeniable. Paying off a credit card with a 22% interest rate provides an immediate guaranteed return equivalent to earning 22% on an investment. No stock market strategy can guarantee these returns, making debt elimination the highest yield investment most people can make. The order within debt elimination matters significantly. Focus on the highest interest rate debts first, regardless of balance size. A $500 credit card balance at 24% interest costs more than a $2,000 balance at 12% interest over time. Many people attack larger balances first because they feel more significant. But this approach costs hundreds of dollars in unnecessary interest payments. Step 3 involves building your emergency fund to cover 3 to 6 months of essential expenses. This isn't just about job loss protection. It's about creating financial flexibility that opens up future opportunities. People with substantial emergency funds can take calculated risks, negotiate from positions of strength, and avoid forced financial decisions that typically favor creditors over consumers. Once your foundation is solid, Step 4 introduces wealth-building strategies that most people never reach because they skip the foundational steps. This is where your refund can start generating long-term wealth through strategic investment in retirement accounts, index funds, or education that increases your earning potential. The specific investment strategy depends on your age, risk tolerance, and financial goals. But the principle remains consistent. Money invested in your 20s and 30s has decades to compound, turning thousands into hundreds of thousands through the power of time and compound growth. Many people make the mistake of trying to split their refund across multiple categories simultaneously. While this feels balanced, it actually reduces the impact of your money. Concentrating your refund on completing one step entirely before moving to the next creates momentum and measurable progress that motivates continued financial improvement. For 2025 specifically, there are additional considerations that make refund strategy even more critical. Rising interest rates mean that debt elimination provides higher guaranteed returns than in previous years. Simultaneously, market volatility creates opportunities for long-term investors to purchase quality, investments at reduced prices. Tax code changes implemented over the past few years also create opportunities for refund recipients to optimize their future tax situations, using part of your refund to increase 401k contributions or open an IRA can reduce next year's tax burden while building wealth simultaneously. 1. Advanced strategy involves using your refund to restructure your payroll deductions for the coming year. If you received a large refund, you're essentially giving the government an interest-free loan. Adjusting your withholdings to keep more money in each paycheck throughout the year allows you to invest or save that money monthly, rather than receiving it as a lump sum. The key is finding the balance between getting a small refund and owing money at tax time. Most financial advisors recommend aiming for a refund between $100 and $500, which indicates your withholdings are properly calibrated without creating a large interest-free loan to the government. This strategy requires discipline because you must consistently save or invest the additional money from each paycheck. However, monthly investing through dollar cost averaging often produces better long-term results than lump sum investing, especially in volatile markets. Another advanced approach involves using your refund to seed multiple financial goals simultaneously through automatic systems. Setting up automatic transfers from your checking account to savings, investment and debt payment accounts creates a set it and forget it approach that removes willpower from the equation. The most successful refund recipients use their windfall to automate good financial behavior rather than making one-time financial improvements. This approach creates lasting change that continues generating benefits long after the refund money is spent. Consider opening a high-yield savings account specifically for your emergency fund, then setting up automatic monthly transfers to maintain and grow this fund throughout the year. Similarly, opening a brokerage account and setting up automatic monthly investments helps build wealth consistently, regardless of market timing. Technology makes these automated approaches easier than ever. Most banks and investment companies offer automatic transfer services, and many employers allow you to split direct deposits across multiple accounts. Using these tools removes the friction from good financial habits. The psychological aspect of refund management often determines success more than the specific strategies employed. Treating your refund as found money leads to different decisions than viewing it as recovered money that should have been working for you all year. Successful refund management also involves planning for next year's refund during the current year. This means tracking deductible expenses, understanding tax law changes, and potentially working with a tax professional to optimize your overall tax strategy. Many people focus solely on maximizing their refund without considering the opportunity cost of lending money to the government interest-free. The optimal strategy often involves minimizing your refund while maximizing your after-tax wealth through strategic planning and consistent saving throughout the year. For families with children, refund strategy becomes even more complex due to child tax credits, education credits, and dependent care tax benefits. These credits can result in refunds that exceed the taxes actually paid, creating opportunities for significant wealth building when managed strategically. The key insight that separates successful refund management from typical approaches is understanding that your refund represents a forced savings plan with a terrible interest rate.